Hi everyone, my name is Ira Walfish and welcome to a short excerpt from our assurance course to help prepare students for the assurance elective exam. Our assurance course covers 3 days. The first day is technical, the second day is case writing where we teach case writing techniques, and the third day is an exam and we do a take-up of the exam. What I'm going to show you now is a brief excerpt from our assurance course where we teach technical. But before I show you that, I'll just spend a minute explaining why technical is important for assurance on the exam. The assurance elective exam covers between 15 and 30 multiple choice or objective format questions, and it covers 2 cases. The multiple choice questions will have between 50 and 70% will be assurance, 20 to 40 will be accounting, and a small amount will be finance. The remainder, like 0 to 10, will be finance, and 0 to 10 governance. The cases will be 50 to 70% assurance, and then 1 or 2 other competencies. The reason the technical is important is because of the multiple choice objective format questions, of which you're going to get a decent number, and it'll help you also to know some of the technical, obviously, in the cases. What we do in our course is we cover 4 topics in 1 day, on the first day. We cover what you see in front of you, which I circled, audit, strategy, and planning. That's part 1. Part 2 is miscellaneous topics. Part 3 is reporting, everything to do with special reports and audits and reviews and notice to readers. And part 4 is professional ethics and legal liability. It's a lengthy day, but we're able to cover everything that I really feel we need to cover in the 1 day. And what we do is we cover about 60 to 70 multiple choice and objective format questions. The multiple choice questions are much quicker when it comes to assurance than they are for financial accounting, and I can cover quite a bit. And 1 day is probably sufficient for the technical for all of assurance. Let me show you an example, and I'll walk through a popular topic. Let's look at risk and how I go over risk from a technical perspective. Okay, risk used to be very popular. Risk and materiality both used to be very popular under the old CKE exam. And over the years, I think they kind of got tired of testing risk, and it became a little less popular. However, obviously, you could still easily get multiple choice or objective format questions on risk, and especially in case writing, it's extremely popular. Okay, so what do you have to know? What do you have to know for risk? So the first thing is, there are a number of different categories of risk. Audit risk, risk and material statement, engagement risk, and business risk. What are these? So I put some underlining here. Audit risk is basically that the financial statements are not materially misstated, or if they are, that's essentially the audit risk. Engagement risk is really dealing with ethical requirements, things like independence. Business risks. Business risks are really anything that impact the business. Economic factors, basically anything that really impacts the business from a business standpoint. And please remember, you don't have to identify everything. Why are not all business risks relevant? Simply because they don't all impact the financial statements. And anything that doesn't impact the financial statements is not really going to be relevant. And then you have the more important one, which is risk and material misstatement at the assertion level. And that includes both the inherent and the control risk. Now, what is the inherent risk? Inherent risk is the risk of error occurring in the first place. It's independent. It's not impacted by the auditor. You come into the job and inherent risk is there. So what impacts inherent risk? Well, look at the first point that I circled here, nature of the item. What is the nature of the item? I think the rest of the points are pretty straightforward and obvious. Nature of the item could be the type of business. For example, a jewelry store. That's always seen as more inherently risky because someone could walk in and 5 seconds later they take out a diamond and there goes $5,000. That's inherently risky. But a lumber yard, if I have a lumber yard, I'm not so worried at 2 o'clock in the morning someone's going to come in and start taking out slabs of lumber. A jewelry shop would be more inherently risky than a lumber yard. But I could also mean by nature of the item, the balance sheet or income statement item, is it inherently risky? So for example, is cash inherently risky? The answer is no. Why would cash be inherently risky? You confirm it with the bank, half the time it comes back wrong, so what? You send it out again. Most businesses don't operate with 20s and 50s, so cash is not inherently risky. But things like receivables or inventories, which may involve estimates, estimate of allowance for doubtful accounts, or provision for obsolescence, that makes it inherently risky. So look at these factors. I just mentioned a few of these. These are the things that make items inherently risky. Estimates make things inherently risky. Things that could be stolen, complex, unusual, transactions, those are things that make inherent risk. So the first type of risk, of the risk of material misstatement, is inherent risk.